And so with that in mind, and with a lot of recent developments, again, Dan has now moved in, and now he lives here at PCNC. We welcome him back. Always a pleasure, Dan. How are you?
Thanks for having me, Alice. Doing well.
Give us an overview of what's happened since, I don't know, you were here about 10 days ago.
Well, the big thing is that China permitted its currency to devalue. Okay, so what it really did is it kind of changed the way, right? 10 years ago, China's currency was not really freely traded at all. They've introduced it a lot of liberalization practices. So now it's not completely freely traded. It moves within a band that the government controls. So they loosened that a little bit and allowed it to readjust a different way, which ended up dropping it by 2%. So it was called a devaluation. And of course, that set off alarm bells, particularly in the United States in the political campaign, because it goes back to the old allegation that China is a currency manipulator. And of course, a 2% devaluation isn't much, but is it going to continue? And so that kind of started to get tossed around as a political football already. I think it's an out-of-date argument. I'm not sure the politicians are keeping up, but if China stays on this path, it's likely to continue to be part of the political discussion.
I mean, if Donald Trump has anything to do with it. I mean, you heard us start the show with who is Donald Trump, in effect. We had a very good conversation and debate with Katie Goldman about, trying to wrap our arms around him. He's not going to let go anytime soon. So to the extent that they have the microscope on them right now, it could turn into a blowtorch if he continues to get traction, right?
Well, it very well could, but here's the facts. Really quick, let me just go over.
No, I
already mentioned that China's allowed its currency to be a little bit more freely traded than it was, say, 10 years ago when the whole currency manipulation conversation started. Number two, in the past 10 years, China's currency has appreciated against the U.S. dollar by more than 30%. So it's hard to say they've been keeping it down, but it's appreciated by 30%. Okay. Thirdly, and this is perhaps the most important part, it used to be 10 years ago that China's currency was completely dictated by trade flows, because its capital account, the ability to invest overseas in China or Chinese to invest overseas, was completely closed. They've now opened it a little bit, not completely, but a little bit. So now capital flows play into the valuation of the Chinese currency. And that becomes particularly important when economic times are uncertain, as they are in China right now. As you know, its economy is slowing, and people are worried about just how slow it's going to get. So what China faces is a capital flight problem. Okay, capital leaving the country, which saps economic strength from the economy. So that is why over most of the last year, they've actually been supporting the currency. Not letting it devalue, as the manipulation argument would suggest, but they've actually been supporting it. And in fact, since they allowed the currency to devalue by 2% last week, it devalued another 2% the day after that. And since then, they've been supporting it. It's back up 1%. So the problem that those that propose to rehash the manipulation argument have is they're not suppressing the currency anymore. They're supporting it.
You made this argument before, because to a lot of local people out there, this is very significant from the U.S. Steel perspective, and that is, of course, U.S. Steel and other companies have gone forward. They've lodged these complaints formally with the government about really, in effect, currency manipulation, amongst other things. The reality is there's a lot of steel. Honestly, my understanding is that there are places outside the immediate Beijing area and provinces that the central government cannot just control, and that there's more steel in China than is necessary, let alone what it does to the entire market.
Exactly. Now, see, and that's why this becomes a little bit technical, but important to understand. If we're going to look at unfair trade practices, you have to start to break it down. What type of practices are we talking about? We could talk about restrictions on imports into China. China's been lowering them for years, particularly when it joined the WTO. So they haven't been really a major factor in a long time. That's why the focus has been put on the currency manipulation argument. But as I just described, that argument's no longer valid.
Okay,
However,
so, wait. So then, one, there's the issue that you're taking the position, if I understand it correctly, that the restriction of imports, meaning those products, goods and services from the United States, I don't care about anybody else, coming from the United States to China, the hassle, the limitation, the burdens of that have been lessened.
Yes.
You're also saying that, unlike the narrative, which is that the currency has been manipulated downward, therefore making it better for those products to be sold at cheaper rates here, you're saying that, in fact, they've actually bolstered them so that won't be the case.
Yes.
Now, you're on to something else.
Well, you identified the third factor in the kind of unfair trade discussion that actually still has validity, which is the fact that in certain sectors, and steel's probably the best example, China has a tendency to overinvest and create tremendous overcapacity. Now, as you mentioned, there's an overcapacity in steel globally now, not just in China. And there are anti-dumping measures and allegations being fired every which way against South Korea, against Japan, not just China. But China's on everybody's list. And in fact, China contributes two ways. It builds too many steel plants, and at the same time, because its economy is weakening, it's buying less steel. So in that sense, that does become kind of, that is a legitimate unfair trade practice complaint.
There's too much steel.
There's too much steel,
they're trying to dump it.
And then the Chinese government looks the other way when their companies try to dump it to at least stay financially solvent. Yes, that's a problem that needs to be addressed. And by the way, building too many steel plants, it's not good for U.S. steel producers because it competes with them, but it's not good for China. It's wasted investment.
No.
They need to stop it for their own sake.
Yeah, there's no question. There's absolutely no question. I mean, it hurts their own internal markets.
Exactly.
That's why one reason we're seeing some of this activity right now. PNC had something very interesting to say, as reported by the Pittsburgh Business Times. We come back, I want to talk a little bit about what it means in terms of this decline, the devaluation of the yuan, and basically what it means to Pittsburgh companies. We're going to come back, we're going to get Dan's perspective. Well, if you haven't noticed, China's become a pretty big deal in the world when it comes to financial markets and economies and things of that sort. So obviously there's a question about whether or not when things go good or go bad in China, how it impacts the United States and what is good and what is bad. It's not always very clear. That's why Dan Joseph is a China guy, also author of The China Learning Curve. Before I go a step further, and I teased a couple of things I want to get to with the audience in a moment, Dan, saw something today in foreign policy right before I left that said that yes, maybe a recession, certainly in light of the incredible growth of China in the last couple of years, that this downturn will not signal or trigger a worldwide recession. Now, tell me about that. A, do you agree with that? I mean, it's a very broad statement. I'm not giving you a lot of details. And two, how in the hell could Greece create so much anxiety and China, like the biggest place in the world, not have a consequence along those lines?
Well, I think actually worries about China have already had a bigger impact on markets over the last couple of months than worries about Greece have.
We're about 1,000 off the high.
Greece is only important. Greece is mainly important because of its connection to the euro. Relative to China, what I would say is China's economy is definitely slowing, and it runs the risk of slowing even further. Some sort of dramatic economic crash in China would have broader impact, but that's unlikely. The problem China faces is it has, over the last 5 years, doubled its debt to GDP ratio, as we've discussed. They've become, they need to transition from that investment-led, infrastructure-led, export type of economy that served them so well up through the 2000s, and they need to transition in a more balanced economy with more emphasis on domestic consumption. And the problem is, in the process of doing that, they've become too addicted to government infrastructure spending and just running up debt to keep people employed. And if they keep doing that, they're going to create a serious drag on their economy. Best estimates now, debt to GDP 280%. Well, 300% gets into real dangerous territory. They could maybe support a higher number because they're at a stage of growth where they're growing faster, but that's real danger.
Okay, well, tell me what that means. Give me an example. Break it down. I don't know math. What does 300% debt to GDP mean? It doesn't sound good.
When we came out of the crisis in 2008, 2009, we woke up and found out that many of the countries in Europe, and including the United States, had pushed up against that debt to GDP ratio of 300%. So that's one of the reasons why economists think that's can trigger kind of a crisis or at least a slowdown, because we've seen it happen with other economies.